Welcome, and thank you for tuning in to Policy Pulse, a KBRA podcast series highlighting regulatory developments that may impact global financial market participants. I'm your host, Emilie Nadler, a director on KBRA's investor relations team with a focus on regulatory affairs. This podcast series gives you insight into the latest regulatory trends and upcoming changes to global financial policy. Join us as we navigate the complex regulatory world and offer perspectives from industry leaders, key investors, and policy experts. In the inaugural episode of Policy Pulse, I'm joined by Larry Hamilton, a partner at Mayer Brown and lead of the firm's U.S. insurance regulatory practice. Larry is also a co-founder of Mayer Brown's Insurance and Capital Markets Convergence Group, which uses the combined talents of the firm's insurance and structured finance practices to ensure that transactions take into account the customs and expectations of both markets. Larry has a 50-state insurance regulatory practice and has extensive experience negotiating directly with insurance regulators, helping clients overcome regulatory obstacles and gain approval for their proposed forms of business arrangements. He regularly advises U.S. and European clients on the insurance regulatory issues associated with new and complex investment structures, including the evolving changes in regulatory treatment of different types of investments by the National Association of Insurance Commissioners, NAIC. In this episode, Larry and I discuss a recent NAIC regulatory development, the Principles-Based Bond Definition, the PBBD. Hi, Larry. Thanks so much for joining me today. I'm looking forward to discussing this very important topic. So let's dive right into the principles-based bond definition, the PBBD. This is obviously a big change for insurance companies and will have implications for the market more broadly. And I know from my conversations with clients, it has been a difficult initiative for people to kind of get their arms around. So I wondered if you could give us a bit of background on the PBBD. Why did the NAIC initially propose it?
Well, thanks, Emily, and it's good to be here with you. I look at the principles-based bond definition as the culmination of a process that has been going on for several years, namely a move away from a purely formalistic understanding of what is a bond to a more substance-based understanding. Originally, the term bond for NAIC statutory accounting purposes included virtually anything that was in the form of a debt instrument. And now it's a narrower definition. Not every debt security is going to be a bond. But this actually started a few years ago. Several years ago, for example, the type of investment called a structured note, where the principal was at risk for something other than a credit default of the issuer, was taken out of the definition of bond and moved under the definition of derivative. So that's an example of where there was more of looking through the structure to the underlying terms in defining what is a bond. The principle-based definition is a much broader redefinition of a bond and is ground up, but it is principles-based. In other words, it's looking at the substance of the investment rather than just the form. And the feeling was that without looking at the substance, there would be investments classified as bonds and being treated as bonds for important purposes, such as how they're accounted for and how the risk-based capital factors are assigned, that might not be reflected of the actual structure and risks of the investment. So that was the reason behind it.
Got it. That's very helpful. And so then under the definition, there are two categories for securities that will qualify as bonds under the PBBD: issuer credit obligations, or ICOs, and asset-backed securities, ABS. Can you talk about the requirements for each category?
Sure, and let me take a step back as I do that, as to what part of the new principles-based bond definition is common to both categories of issuer credit obligations, or ICOs, and asset-backed securities, which we'll call ABS. So the primary definition under the principles-based regime is that a bond is a security that represents a creditor relationship whereby there's a fixed schedule for one or more future payments, and which qualifies as either an issuer credit obligation or an asset-backed security. So always has to be a security, always has to represent a creditor relationship, always has to have a fixed schedule for one or more future payments. Those are common elements of both categories. An issuer credit obligation then is one of the two categories, and perhaps the easiest in some ways. It is a bond for which the general creditworthiness of an operating entity is the primary source of repayment. So the classic easy case for that would be a corporate bond, where you're looking to the corporation's general creditworthiness for repayment, or a government bond, municipal bond, and those are issuer credit obligations. If you are an issuer credit obligation, then you have completed the requirements to satisfy the bond definition as such. Asset-backed securities are where the repayment is not looking to the general creditworthiness of an operating entity, but to the cash flows from some underlying collateral. It's not the same definition, by the way, as ABS under the federal securities laws. There may be structures that wouldn't fail the test to be ABS under federal securities laws, but be ABS for purposes of the NAIC's principles-based bond definition, where it again is going to encompass anything where the repayment is supported by cash flows from an underlying defined pool of collateral rather than general creditworthiness of an operating entity. And if it's ABS, then there are two new criteria. One of them is that there needs to be substantive credit enhancement in the structure, meaning that the holder of the ABS is economically in a substantively better position than if they held the underlying collateral directly, and a better position because of the existence of a first loss subordinated interest or over collateralization, potentially some kind of guarantee from a sponsor or third party, but something that means you're better off than if you directly held the underlying. So that is always required for ABS status. And then the second criterion depends on what the collateral underlying the ABS is. If the collateral consists of financial assets, then there's no further requirement. If the collateral consists of non-financial assets that are generating the cash for repayment, then there is a requirement that there be meaningful cash flows. And meaningful is just like substantive, meaningful, these are principles-based concepts. So you have to look at what the specific underlying collateral is and the nature of cash flows that it generates. A way that I kind of summarize what the meaningful cash flow requirement is, try to translate, it means bond-like cash flows. You have a bond that needs to be repaid. So are you getting cash flows from the underlying that are of a nature to be able to meet that repayment? And you think of examples of some cash generating non-financial assets that could underlie an ABS. Think about leases or mortgage servicing rights where there's a performance element. Or I had looked at one recently that involved YouTube receivables. For people watching YouTube, it generates royalties. The ABS was securitizing those YouTube royalties. Those royalties are not a financial asset. So the question is, how do you get cash flows out of those that would be able to support a bond under the ABS definition? That's probably enough for now, but it's a complicated definition. It's bifurcated. One other thing I would mention, that funds can be included as the issuers of issuer credit obligations. The original definition had only registered funds being eligible to issue issuer credit obligations. If the fund was unregistered, then its debt had to be analyzed as ABS. But that was changed in the last summer before the definition went into effect, so that if the fund is an operating entity, then its debt obligations can be issuer credit obligations. An operating entity is an analysis that looks at whether the primary purpose of the fund is to generate equity returns to equity investors, and the debt is ancillary to that primary equity investor objective.
That's really helpful, Larry. So we now kind of have a pretty good understanding of these two categories. But so what happens if a bond does not qualify under the principles-based bond definition?
Well, that's a great question, Emily. And it's interesting because when the principles-based bond definition was first being drafted several years ago, there was a fear, I think, among many that if an instrument, a debt security, failed to qualify as a bond, it might get treated as equity. And I think one of the reasons why people thought that was that some of those bonds that were in danger of losing bond status under a new definition did have underlying equity interests. And in fact, were being used to enable insurance companies to invest indirectly in certain type of equity interests through a bond. So the fear was, oh boy, if it fails the bond definition, it's going to equity with a 30% risk-based capital factor, order of magnitude different from what an investment grade bond would be. But in fact, for life insurance companies, that is not the consequence. If the security is a bond, it goes on Schedule D. D is in Delta. And benefits of being on Schedule D is that the bond is carried at amortized cost. It doesn't have to be marked to market as long as it's above an NAIC 6, meaning it's not impaired. And the risk-based capital factors for bonds are going to be determined by, in many cases, about 80% of the time, the filing exempt designation with the NAIC, the risk designation, which is derived by translation from the rating assigned by an NAIC recognized credit rating provider. So those are all good things that insurance companies are looking for. If a security becomes a non-bond debt security under the new regime, principles-based bond definition, then it goes to Schedule BA instead of Schedule D. And on Schedule BA, it's going to be carried at the lower of cost or fair value. So you have introduced, and I'm not a statutory accountant, so anything I say that has a statutory accounting flavor should be considered subject to opinions of statutory accountants at insurance companies and in their external accountants and ultimately state regulators. But a Schedule BA asset then doesn't get the benefit of amortized cost accounting. And very importantly, it doesn't get the benefit of the filing exemption. So it's not any longer going to get its NAIC risk designation by translation from the credit rating agency rating. It's going to have to be filed with the Securities Valuation Office of the NAIC, the SVO, and the SVO will perform an assessment and assign a designation. And that would be the NAIC designation for a non-bond debt security or a life insurance company. If the insurance company is a P&C or health insurance company, currently there is no provision for them to file it with the SVO and get a designation that would be used to determine the RBC factor. It's just going to go to 20% for a health or P&C insurer. There was a referral by the Statutory Accounting Principles Working Group to the RBC working groups to consider changing that so that, like life insurers, those types of insurers could file a non-bond debt security and get an NAIC designation that would be used to determine the RBC. But my understanding is that the investment component of RBC for P&C and health insurers does not loom as large as it does for life insurers, and there may not be as much of a pressure to do that. One other really important thing about being a non-bond debt security is that the underlying collateral needs to itself consist of admitted assets in order for the non-bond debt security to be an admitted asset. And that's pretty big because if you meet the ABS definition, the collateral can be anything. The collateral does not have to consist of admitted assets. If you fit with the ABS definition, meaning the substantive credit enhancement and the meaningful cash flows, then it is a bond. But if it's not a bond and you don't have admitted assets as the underlying collateral, then the non-bond debt security becomes a non-admitted asset, which is worse than just being a non-bond debt security. It actually is it actually has to be non-admitted. So that's perhaps the most momentous potential consequence, depending on the nature of the underlying collateral. For example, if you had student loans, I've talked about that one before, student loans, consumer loans, those are not admitted assets that the insurance company could hold directly, only if they're successfully securitized into an ABS. And that's where fulfilling the ABS definition becomes critical.
So, what are the biggest gray areas under the bond definition? From your conversations, are there sectors where insurance companies are worried about securities not qualifying?
Well, the one thing I will mention here is that the new principles-based bond definition is the Statutory Accounting Principles Working Group, which I'll call SAPWIG if you don't mind, has already issued a set of questions and answers on application of the principles-based bond definition to specific situations. And that was developed by an informal working group consisting of regulators, industry participants, accountants, and very helpful and in some cases revealing as to how to understand and apply the principles-based bond definition. But one element in there that I think caught people's attention was the treatment of single asset, single borrower commercial mortgage-backed securitizations that have a unitranche structure, only one tranche. So you have a commercial mortgage loan, and then it's held by an SPV. The SPV issues a debt security backed by that loan. Think about that now. It's the SPV is not an operating entity. It's issuing an asset-backed security. So you have to answer the question: is there substantive credit enhancement? And then you say, does the holder of the mortgage-backed security, are they in a different position than if they held the underlying commercial mortgage loan? If it's unitranche, they're not. If there were multiple tranches, then the senior tranche would benefit from the credit enhancement of the subordinated tranche. And bingo, you'd have the asset-backed security definition satisfied. But in a unitranche, you don't have that. So one of the Q&As actually points that out and discusses how that's an example. So in that case, you would have to file that's a non-bond debt security now. So you'd have to file that CMBS with the SVO to get the designation. In fact, there was a kind of mad rush at the end of the year, I understand, by insurance companies that held those types of instruments to get them to the SVO and the Structured Securities Group, and which indicated that they would do their very best to expedite that analysis and assignment. So that's one that was just very clearly fell out of the definition. But you can't always say black and white whether it's one thing or the other as a category. For example, collateralized fund obligations and rated feeder notes. Those structures don't automatically qualify as bonds, but they're not automatically excluded either. A rated feeder note can be a bond under the PBBD. You have to look through the structure and evaluate whether there is substantive credit enhancement and whether the underlying assets are financial assets or non-financial assets that generate meaningful cash flows. If you have underlying funds, master funds in the feeder structure that hold debt instruments that themselves generate scheduled payments of principal and interest, well, those are financial assets, and they're clearly of the type that could support the cash flows on the feeder notes. And then you'd also be looking at the subordinated tranche in the feeder fund and whether it provides substantive credit enhancement, taking into account the nature of the underlying collateral, where if you had credit instruments being held by the master fund, then you might not need as much of a first loss tranche. If you had equity funds, you might need quite a bit. And you would also need to look at what are the processes for ensuring that there will be meaningful cash flows. So I've seen many, many rated feeder note structures that to me looked like a statutory accountant could find that they meet the definition. I've seen some CFOs as well that had the same potential to be analyzed as meeting the ABS definition. But it's substance over form, remember. The form is not automatically included or excluded. You just look through the structure and analyze the two key elements of substantive credit enhancement and for non-financial underlying collateral, meaningful cash flows. And I should say at this point, since we're talking about the subordination, bear in mind that that subordinated tranche that provides the credit enhancement to enable a senior debt instrument to be a bond, the subordinated tranche that provided that enhancement is not going to be a bond in virtually every case. It's going to be what's called a residual interest or a residual tranche. And by the way, footnote is that for life insurance companies, residual tranches now receive a 45% risk-based capital factor rather than the 30% that would apply to ordinary equity.
I think you've highlighted one of the challenges, which is that this is principles based. And so as you talked about, it's substance over form. And so there's definitely a burden being put on the insurance company to develop their own guardrails or firm view on the bond definition. And the NAIC really wants insurance companies to provide analysis for how their firm will categorize securities. But I wanted to understand, how is this information actually verified by the NAIC?
Good question. So this is also an occasion for me to add to what I said earlier about the bond definition. There's another element of the principles-based bond definition, which is that if the underlying assets are equity interests, there's a presumption that is rebuttable, but it's a presumption that the security backed by equity is not a bond. If you have a debt security that the insurance company wants to treat as a bond and believes that it meets the definition, then if the underlying is equity, then the insurance company needs to do a documented analysis, actually needs to write it down at the time of investment as to why the presumption that an equity-backed security can be turned into a debt security, why that is valid. You would look at some of the same things that we've talked about. You would need to show that the characteristics of the underlying equity interest lend themselves to predictable cash flows. You would need to show that the underlying equity risks have been redistributed through the capital structure of the issuer so that the bond or the debt instrument that's held by the insurance company does not any longer have a substance that's aligned with the underlying equity, but that substance has been transformed through the ABS structure. So, and you would look at a lot of different factors. There's a non-exhaustive list in SAP 26 of factors that would be used to rebut that presumption. So the first thing I would say in answer to your question is, if you have underlying equity interests, then one thing that's absolutely required is a documented analysis at the time. I would think that an insurance company that's looking at a debt security and considering whether it's ABS and meets the principal-based bond definition would document their analysis in almost every case. But I would say, I just want to point out that the definition itself requires the documented analysis when there's underlying equity. And then also there have been more fields that have been added to the statutory investment schedules for asset-backed securities. Schedule D has been bifurcated now in 2025 between issuer credit obligations and asset-backed securities. And there are more fields that need to be supplied, filled in for asset-backed securities that will also assist in drilling down on some key components of the definition, I suspect. But like the financial reporting currently, it is a matter for the insurance company's statutory accountants to determine in the first instance, subject to the review of their external statutory accountants, and ultimately to the review of their state of domicile examiners. And the state insurance department always has the final word on these matters. The statutory accounting framework has guidance in the form of the SAPs, and there are other forms of guidance like the Q&As now, but they ultimately, it all ends up with the state regulators. And so at times when there are financial examinations and the regulators or their representatives are actually going through the financial statements with a fine-tooth comb, that's when most likely any kind of controversial decision is going to be scrutinized more closely. And in the meantime, it's really up to the insurance company and its accountants to do their very best to get it right.
I wanted to switch gears slightly for our last question, and I just want to ask you, looking out into 2025, are there any big NAIC initiatives that you're watching over the next course of the year or next few years?
Well, there are several. There's the achievement of adopting the principles-based bond definition was a huge milestone, and I think everybody was taking a bit of a breath after that. But the things never stand still. One of the adoptions that was done this past year that doesn't become effective until 2026, January 1st, 2026, empowers the NAIC's Investment Analysis Office, the SVO, and the Structured Securities Group to challenge the use of filing exemption on a specific security if they believe that the NAIC designation derived from the rating agency rating is not a reasonable assessment of investment risk for regulatory purposes, and that the difference is 3 or more notches, and that there will be a process that's initiated by the NAIC staff and then affords the insurance company that holds the security a chance to respond. It can also involve the issuer and the rating agency. The insurance company can bring them into the discussions. In the first instance, the insurance company has to make a filing of the kinds of information that they would have filed if they had filed with the SVO in the first instance. And then after a period of information requests and presentation of what the insurance company wants to present from their side, if the SVO still believes that there's the discrepancy of 3 notches or more, then it goes before a group of state regulators, subgroup of the Valuation of Securities Task Force of the NAIC, to make a final decision whether to maintain the rating agency derived designation or to substitute the NAIC staff's proposed designation. And in that situation, by the way, if a security has a second rating that's not been challenged, then that would also kick in potentially in preference to, it would remove the challenged rating, but would still allow a second rating that had not been challenged to be used. So that's a process that everyone is waiting to see how it goes. That it has been said that it's not intended to be used often, that it's not directed against any rating agency or group of rating agencies, and that it's not directed against any asset class, just individual securities where the NAIC SVO staff believes that the rating derived designation is not a reasonable assessment of investment risk for regulatory purposes. So a lot of eyes on that, but it's still almost a year away. Speaking of rating agencies, the NAIC, the E Committee, the Financial Condition Committee, did decide to develop a due diligence framework for credit rating providers, and that an RFP was adopted in fall. And in fact, I think that the end of this month is the deadline for anyone who wants to apply to do the design of a due diligence framework to submit their proposal. So that's very much in the works. There's a lot going on with RBC right now for structured securities. There are two separate work streams relating to CLOs, collateralized loan obligations. One of them is conducted under the auspices of the Valuation of Securities Task Force led by the Structured Securities Group at the NAIC that involves developing a modeling methodology for assigning designations to CLOs. And the leader of that, Eric Kolchinsky, the director of the Structured Securities Group, has indicated that they're targeting the end of 2025 for completing that design of methodology. And then meanwhile, there's a separate work stream under a different working group called the Risk-Based Capital Investment Risk and Evaluation Working Group that has a broader project for assessing how RBC should be assigned for structured securities with tail risk. And they've started their project with CLOs, and that's being led largely by the American Academy of Actuaries. And they're going to be giving a progress report at the spring national meeting of the NAIC in March. So everyone is waiting very eagerly to hear what their early findings and recommendations are. And I'll just mention one other proposal which has been percolating since 2024, which is to require asset level reporting of investments that are used to collateralize reinsurance obligations in a funds withheld or a modified co-insurance ModCo arrangement. So that's a relatively early stage proposal, but is something that's gotten a fair bit of attention and probably will be determined in 2025. In general, I think 2025 is going to be a year of RBC because of all the things that are going on with the CLOs, but more broadly, there are a lot of questions being raised about RBC. It's a system that has worked well to help insurance regulators detect weakly capitalized companies so that they can intervene in a timely fashion. But it is a system that's over 30 years old. The basic framework is the same as the original one from 1993. And I wouldn't be surprised if there's a broader look at the whole RBC system in 2025. So maybe that's enough of things to look forward to. It's certainly quite a lot.
Definitely a lot to watch, I would say. There's a lot going on at the NAIC. There always is. But thank you so much, Larry, for being on our first episode of Policy Pulse. You're always such an incredible resource for all things NAIC. So I really appreciate you coming on to discuss the bond definition. So thank you again. And I look forward to seeing you at the spring meeting for the NAIC in Indianapolis.
Likewise, Emily. Thanks for the opportunity to have this conversation.
This concludes our episode. Thank you for tuning in. New episodes of Policy Pulse air every month. In the meantime, please visit kbra.com to access our other podcast series, as well as our ratings and research.